screen. In commodities news, gold prices rising for a third straight session earlier as U.S. President Donald Trump announced a new set of tariffs on Canada and broader tariff threats against other trading partners. Now, Trump also said the European Union could receive a letter on tariffs later today. We are all still waiting, thus throwing into question the progress on our trade talks between Washington and the 27-nation bloc. Gold last trading $3,373 per ounce. Some of the top stories that we've been looking at the moment. Let's talk about what they are doing on the markets. And for that market commentary, Keiran Witthuhn, portfolio manager, Robert Cowen Investments, joins me to talk about what has been mostly a red day on our local markets as well as international markets in Europe. And that story goes back to one man and one man alone, President Donald Trump and his tariffs. Your views, your insights, Keiran, in terms of how markets are interpreting what the president has been pronouncing and how investors have taken it.
Good afternoon, Godfrey. Good to be on the show here. Sorry I could not join in person in the studio. It's been a bit of a crazy one at the office today. Yeah, so like you said, the market's reacting negatively throughout the world. It's a risk-off sort of day. Trump coming out quite hard on the tariff threats today. And I think he's sending out lots of letters throughout the week. Obviously, South Africa got our letter that there'll be a baseline 30% case of tariffs for us. But yeah, I think the Rand and the JSE, especially getting caught up in that. There's quite a few, I think, maybe country-specific issues happening in South Africa at the moment, but South Africa not having a good day today. And I think we've seen that follow through now in the West with the US markets also down today. But I'm not sure if the market is going to be taking Trump seriously. We know he comes out hard. It's part of his negotiating style. And a lot in the market we have seen in the past maybe 2 months are taking him less seriously than they initially did. But obviously, if the president of America is announcing a huge new bout of tariffs, the market's not going to react positively. So, yeah, I guess let's wait and see if it actually does take place. But I think, like I said last time, corporates and companies around the world, individuals are going to have to accept baseline tariffs of above 10%, which will be the first time in years that we will see that.
Yeah, and that was the point I made earlier as well in another conversation, that I think the only thing that's certain is that tariffs are not going back to before, we have to put it in quotation marks, Liberation Day, as President Trump announced. But I wanted to explore this other side of the thinking of the markets because, as you say, what we have seen generally is almost like a return. I'm going to call it the taco trade, right? Trump always backs off. I heard the president doesn't like it, but I think the market appears to be taking the same view. But today we are also seeing quite a bit of money coming off the table. If you look at the picture that's coming up in Europe, which is still waiting for that tariff later, by the way. Your interpretation of the moves we've seen in Europe?
Yeah, it's interesting because Europe is actually seeming to be fine with a 10% base rate of tariffs, whereas earlier they were not fine with that. They were quite keen to retaliate to Trump's tariffs. But I think the conversation has eased a bit there. And I say the conversation and the rhetoric, I still think there will be tariffs, but it's good to see that the rhetoric has eased a bit. And obviously there's still the fiscal expansion that is buoying European markets. Obviously, a lot of that going into the defense industry. After the German elections, they're promising to spend pretty big. And this is going to increase GDP growth likely a year or two out, whereas the US is kind of seeing the opposite. We're seeing growth maybe slowing down. This is seeing yields, obviously, in the US coming off slightly, European yields increasing, led to stronger euro. And it's quite tough, Godfrey, to say how long this will play out, but a lot of it has played out already, of course. European markets have been strong this year, and yeah, another decent weeks for them. And we tend to not invest on the top-down level, so there are companies in Europe that we like, but we still think that the US does hold the best opportunities.
Yeah, so let's talk about that U.S. picture, and perhaps let's also include in it the quarrel or the ratcheting up of the quarrel with Canada, where we saw overnight the president saying he will impose 30% tariffs on Canada. The U.S. picture, when do we begin to see the impact of these tariffs? I don't know whether that's negative for U.S. companies or positive for U.S. companies.
So I think you will already start seeing some of the impacts from tariffs come through. But from a corporate level, it does depend how long the inventory cycle of a specific corporate is. Some of them will have shorter inventory cycles, some of them will have longer inventory cycles. And the ones that have shorter inventory cycles, like the retailers, for example, would have already had to bring in supplies or inventory at the higher cost. And I think we have seen that they are starting to pass that on to consumers, mixed with corporates taking the hit of it. I think the combination of both. And I guess then onto the earnings season, it's going to be interesting to see which companies are able to stomach the increase in tariffs in their margins, and which ones do have pricing power, and which ones are going to be really losing out, either in units sold to customers, or they're going to lose out in the prices they can charge. They're going to have to sort of take it on the income statements. Yeah. But I think, Godfrey, there's June CPI coming out next week. We'll have an idea then, but I think a lot of people are expecting it into the second half of the year. We'll get an idea on whether these tariffs are going to be inflationary. And until then, it's quite hard to say. There's a lot of uncertainty. But at the moment, I must say that there's still more disinflationary forces actually in the US economy than inflationary forces. But of course, that can change in a few months. So it's looking good, but let's see what does happen in the next few months.
Yeah. This week, of course, will also go down in history as that week when there was a company in the world, in the U.S. in particular, that became a $4 trillion company, Nvidia. I had a conversation earlier on with my market analyst, and he was talking about the fact that what the market is pricing in is that this is a company in a very strong position where demand for its products is likely to be rising. Your thoughts in respect to Nvidia and whether there is more to come from here?
Yeah, so obviously Nvidia has pretty much driven the US market forward now for 3 years. And it must say it was very cheap a few months ago, got down to about the $110 level. It's now shot right back up, probably 50-60% since then. And I think at the time we were very, very bullish on Nvidia, but it has now run again. So I think we are likely to be slightly underweight Nvidia at this point, definitely still holding it. We want exposure to Nvidia. We are very bullish on the AI trend. We think Nvidia is the granddaddy driving it forward, and we do think that is going to continue going forward. But with that, we do expect markets to remain volatile, and politics can ultimately send this thing down 20%. We know that Jensen Huang is at the White House today, and companies that have been at the forefront of politics, we think of Tesla, we think of Apple, have not had a good time. Even Alphabet's been a bit involved with politics. So as long as Nvidia can stay neutral with China, neutral with the USA, I think it's going to keep driving it forward. But we know Trump does not want China to get Nvidia's chips. But still, I think there's reason to be bullish with Nvidia going forward.
Yeah, my next question is two-pronged. We saw yesterday the Nasdaq as well as the S&P at records. We're treating today a little bit. At the same time, of course, we're expecting our second quarter earnings to be coming through. How to play the market ahead of those two?
So earnings growth of 13% is expected for this earnings season, which is high. This is for the S&P. That's above 10% out of the past few years. On the tech side of things, the Nasdaq, which is the more tech-heavy index, that's expecting earnings growth of 20% this quarter, which again is high. So it means there's less margin for error there's less downside priced into this US market than there was a few months ago. And I think companies that do miss will be severely punished. We've seen that in the past few years play out with earnings season. But I think we are still constructive, like I've said quite a few times, on the US in general, on the tech sort of story. There's been a lot of headlines around Iran and Trump and tariff. We do think artificial intelligence is impacting or changing the world that we see right in front of us. And there's still a significant amount of CapEx spending going into artificial intelligence. So we do think that companies exposed to that CapEx or that are going to benefit from that CapEx spending are going to show positive numbers. The US consumer has also remained quite strong, or the top end of the US consumer. So we think that earnings are likely to be strong still in the US. But I think a lot has been priced into the markets, but I think we're still more, on balance, still more positive than negative ahead of this earnings season for the next few months.
Absolutely, and we continue watching, of course, waiting for that letter to arrive for the Europeans and calculate what that means for the markets. For today, thank you very much, Keiran Witthuhn is portfolio manager, Robert Cohen Investments, with our Market Watch for today. Which market, as I was saying, we know ended up in the red today, and we also seen some of that pressure transmitted through the South African rand. I got a note from my friends at Keller Securities, and they have got an interesting rating here on Stral, and they say that it remains on their high conviction SA Inc. Play, and they think it offers substantial earnings leverage to a recovery in input costs and poultry pricing. This is for full year 26. They expect earnings to rise as much as 132%. That's Stral, liked at Keller Securities. 14 minutes past 5 is your time. We're going to take